What is happening, people? It is your boy Jack, and today we're coming back at you with another new video. So the last time I spoke on stocks that I am personally looking to buy or have already bought or will buy very soon, it did really well. So I said people obviously enjoyed that video, let's make another one, baby. So if you did enjoy that last video, and if you enjoy this one, please do me a favor, smash the like button for me. It helps the video get seen by more people. Drop me a comment, let me know what stocks you're currently looking at. Subscribe so you never miss a future video. But anyway, really excited about this one. I think I have 5 more stocks that you're all going to enjoy hearing about. So let's just get straight into it. And the very first one we're going to speak about is Walt Disney Company, a company who I actually purchased earlier on in the week. I think we all understand who Walt Disney are. They make Mickey Mouse, they make cartoons, they made probably some of your favorite childhood films, they own Disneyland, they have an awful lot going on. But why should we buy them now? Why are they of particular interest now? Well, let's just have a quick look, obviously, at the start of their dividend safety, which is 65, so it's a relatively safe dividend safety score. They are an absolutely massive company and they have a dividend yield of 2.05%. So we've kind of touched on this in previous videos, but usually the biggest companies in the world don't have the biggest dividends because they don't need to. People want to invest in them because they have so much potential for growth in general. The very first thing we're going to have a look at, the virus weighs on Disney, but long-term outlook appears intact. And I think that should be fairly obvious. You don't have to be a genius to figure this out. Disney is not going anywhere. They're one of the biggest companies in the entire world. They're absolutely massive. Yes, they're getting hit particularly hard. They've had to close down their shops and everything along those lines. Not their shops, their big Disneylands. They've had to shut down their parks. That's the word I'm looking for. So obviously they are getting hit hard. But I've said this, I repeat myself every video, so has absolutely everybody, or at least 99% of companies. But their long-term outlook appears intact. And that is what is important for a long-term investor like me, is that their long-term outlook is still positive and that I still believe that they will grow in the decades to come. That's the important thing, not what's happening right now. But Disney is a company who has so much cash lying around that I don't see how they couldn't possibly get through something. Even a worldwide epidemic, they're going to be able to get through it and come out of it on top. We're looking at a company with over 5 billion in cash as of the last quarter of last year. They're going to be okay. Now we're having a look at Disney's stock chart set to max, and we can see obviously boom, boom, boom. Let's go to 2010. It's been growing, it's been growing, it's been growing, up, down, up, down. It peaked out at about just over $150, I believe, and now we are sitting at $85.98. If we go to the 5-year chart, we can see a similar story. It was a bit all over the place, to be honest. It wasn't doing anything crazy. Then boom, we shot up, and now we are at the lowest we've been in over 5 years. You could have invested in Disney 5 years ago and you would be down right now. If that doesn't say that this is a good time to buy, now obviously it can go lower, but think about it, a company as massive as Disney, you could have bought 5 years ago and been down. It's incredible to me. I see so much potential for this company. I'm very excited to own this company. Just have a quick look at this with Disney Plus as well. 10 million users subscribed to them within its first day of operation, and as of February it had 28.6 million. I'm not sure where it's at now, but we can assume it's probably over 30 million. So that is also going to help them up their cash and help them get through this tough time. So see, 38% of their sales comes from media networks, so from showing their programs. A lot more people are going to be watching a lot more TV now because they have nothing else to do. They're all stuck at home. So this will also help carry them through the tough times a little bit. Obviously their parks and resorts, boom, they're pretty much going to be gone for the foreseeable future. That income is all going to be lost. But Disney have a lot of money. They're going to be okay. Disney aren't going bankrupt. I think pretty much anybody can make that assumption. Again, this is one company where I just don't think you have to be a genius to invest in it. I think if you're a long-term investor, you cannot go too wrong with a company that is as massive and as prominent in their industry as Walt Disney is. They are not going anywhere. We can see that they have a dividend growth streak of 10 years and they have an uninterrupted dividend streak of 27 plus years. So during the recession, they may have had to not up their dividend for a little while, but they still paid it out, and that is important. So if things are to go badly now, they're more than likely still going to be able to pay out their dividend. It just may not grow for a little while, and that's fine. And let's just have a look at a few more quick points. Their debt levels look good. They've paid uninterrupted dividends for more than 25 years in a row. They've generated positive free cash flow in each of the last 10 years. They continued paying this regular dividend through the recession, and they performed pretty much as well as the market during the recession. Their stock returned minus 55%, the S&P lost 55%. So recession proof somewhat. They're still going to lose quite a bit, but they're always going to bounce back. In the last video we spoke about Coca-Cola, and today we are speaking about Pepsi. They're very much so in the same boat, and they very much so both have incredible long-term outlooks. Pepsi right now is actually doing considerably better than Coca-Cola as well, which is quite interesting to see. But let's just speak a little bit about why they are a good investment right now. So we can again have a look. Dividend safety of 93. They're very safe to pay their dividend, and they have a yield of 3.68%, which for such a big company is really, really attractive. So boom, now we're having a look at Pepsi's. We're starting off with the max chart. Ooh, it's been steady, 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 baby, the whole way up. Now let's drop down to the 5-year chart. Again, it's been steady, 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 and then boom, big old drop. Now, Pepsi haven't seen as big of a drop as a lot of other companies have. Last time it was down at this price was, where are we, 103-ish, pretty much mid-2018. So there's a lot of companies who are much lower than that. Pepsi still has some room to drop potentially, but I still believe in the long term, the outlook has not changed. They are going to be going much higher. I'm very excited to own this company. And I just think this is such a tasty discount when it was nearly $150 not too long ago. A month ago, not even. Just have a look. They have grown their dividend for over 47 years. It's crazy. They're going to do everything they can. During the recession, boom, they grew that dividend the exact same as they always have been. Now, again, let's just have a quick look at a few things. Their debt levels look decent. They've paid uninterrupted dividends for over 25, nearly 50 years. They've generated positive free cash flow in each of the last 10 years. Their sales were relatively stable during the crisis by 0.5% dip. They significantly outperformed the market and returned minus 35%. So this is a company that definitely, when the recession hits, you'll be happy to have them because they won't get hit near as hard as a lot of the other companies will, which is awesome considering the fact they have such an attractive dividend as well. It's amazing. Here we're having a look at the image below shows PepsiCo's 22 brands with over 1 billion in sales in the last 12 months. So there's obviously Pepsi, Lay's, Mountain Dew, Gatorade, Quaker Oats, Cheetos, some other places I don't know too well, 7-Up, Doritos, Pepsi Max, Walkers. They own a lot more than just the drink that is Pepsi. They have a lot of money. We can see here they have total assets currently of 78 billion, which is quite nice. And their current liabilities are only 20 billion. So that is very, very nice for us to be looking at from a long-term point of view. They do seem to be quite good at handling their money. We can see their return on equity is 50%. Return on invested capital is 20%. Their free cash flow is 8%. And their operating margin is 16%. So they are looking like a very nice company. And again, their debt, they are quite good in regards to debt. They have a little bit... Their debt is right on the edge of where you want it. It's okay though. Pepsi, they're not going anywhere. Yet again, it doesn't take a genius to know that Pepsi's not going anywhere. They're a massive worldwide brand. People will buy their products. So the next company we're having a look at is Cisco Systems. I think I've spoken about these before, but anyway, we're going to go over them again. So they're in the communications equipment industry. They have a dividend safety of 91 and they have a dividend yield of 4.04%. So obviously this company isn't as well known as Disney or Coca-Cola. So we need to have a little bit of a look more into what they do and what makes them a good investment. So let's speak a little bit about who they actually are. They're one of the most important technology companies in the world. Okay, they sell a wide variety of products. The main things they do is they sell switchers and routers that help connect computer networks with each other. It is that simple. That is what they do. That's their main thing. And this may be one of the reasons they haven't been hit as hard as a lot of other companies have lately, is because routers and switchers, people are still going to need to buy them, especially with more people working from home now. They could actually potentially go up. They have potential to be selling more and more. And that's not the only things they sell, obviously. They also sell applications, security and services, which consists of technical support, subscriptions and software spread across its various segments. We can see here they only have a dividend growth streak of 8 years. They only started back in 2010, but they have been growing it extremely quickly. Over 14% in the last 5 years, which is very fast. 10% in the last year, fast. Have a quick look at them. They have more cash on hand than debt. They've paid dividends for 8 years, we spoke about. They've generated positive free cash flow in each of the last 10 years. Their sales were down that during the economic crisis. But let's have a look at this, right? They returned minus 59%. The S&P lost 55%, so it performed as well as the average company. So again, not necessarily recession proof, but it shouldn't get hit any harder than your average big company. They most recently recorded total assets of 90 billion, which is an above average amount for most companies, and suggests the company could have greater resources to support its dividend if times get tough, which is great for somebody like me. It means even when we go through a stage that we're going through right now, they can keep paying me a dividend. They won't have to cut that dividend. They should still be able to grow that, and most importantly, I will still get paid. We're just going to have a quick look at their 5-year chart. We can see it's kind of been steady, up, and now boom, it's down. We're down to 35.60 a share. It was up as high as kind of $57, $58 a share. We haven't seen this price since back just at the end of 2017. Jeez, it's awesome. It seems like a really good deal to me. Yeah, I just think anything that's to do with being online right now is quite a good investment. Communications equipment falls into that category. So I think they're quite nice. They still have that really attractive dividend yield. I do believe heavily that they're going to want to grow this even when times get tough. And that is why I already own a position in these and I plan on buying more. Now, boom, we're having a look at Uber technology. So if you're up to date with the stock market, you know that there has been some crazy things happening with Uber, and we're going to go through them all and why they have happened. They don't currently pay a dividend, so there's no dividend safety or anything along those lines. And I know I am primarily a dividend investor, but I don't mind throwing a few really cheap growth stocks in there every now and again. So let's just have a look at what Uber's been up to the last week. That's all we need to speak about even, is the last week. So here is their 5-day chart, and let's just see, we opened at about $20, okay? It started to go down and down and down. Bang, all the way down to pretty much $14.50, okay? A massive drop, so cheap for what Uber was. Boom! out of nowhere, we're trading up as high as $23.50 from $14.50. Pretty much almost a 40% increase like that overnight. Now the reason for this was because the CEO came out and basically said they have enough cash to get them through any tough times, which then obviously gave the investors courage to go in and invest. They may have been worried that Uber could potentially go bankrupt. I personally don't see that happening, but again, anything can happen. So you probably all know what Uber does. We know them for Uber and Uber Eats primarily. They're basically a company that lets you go onto your phone and get a taxi sent straight to your door. It's going to tell you how much it costs to go where you want to go before you step foot in the taxi. They're all registered drivers. It's just a very safe taxi service, and Uber Eats is basically a food delivery service. So Uber actually only went public very recently in May of last year, so they were a very new IPO, and you can see when they came out, the company is the highest value tech IPO since Facebook and Alibaba. And now they are trading at $20. Look at where Facebook and Alibaba are right now. This is crazy. The growth potential is disgusting. Obviously, like with anything, some risk comes with it. But I think the potential here is absolutely amazing to see hundreds and hundreds % of return on investment in years to come. That is exactly why I will be opening a position in Uber, and I'm just going to dollar cost average if they continue to drop. I think when things finally recover, Uber are going to do amazingly. Now I do think they will be hit particularly hard over the coming months, and that's why I'm not too pushed on opening a position or a big position very soon. I do want to open a position this week, but I'll just dollar cost average as things go down. So I won't be making a massive investment just yet, but we'll be making an investment nonetheless. Another company we're having a look at is Facebook, and again, it's another company that doesn't pay a dividend. Now I know I am a dividend investor, they're the stocks I primarily invest in, but if I see a well-priced stock that I think could grow and has massive potential to grow, why would I not invest just because they don't pay a dividend? That seems a little bit silly to me. So this is a growth stock. So they're currently sitting at just below $150. They have a market cap of $427 billion. We all know who Facebook is. We know that their main website is Facebook. They also own WhatsApp and Instagram. They're an absolutely massive, massive company, probably the biggest in the social media world right now, and social media is booming. So we're just gonna have a look at their max stock chart, right? And we can see it started here back in 2012 and it has climbed steadily ever since. There was one big dip here, boom, where we dropped as low as $124, and then it recovered, it hit new highs yet again, and now boom, another big dip. We're just trading just below $150. Now, personally, I think it would be crazy if it was to go below this $125 point, which would only be another 20% drop. Now, obviously, there's always the potential, but I think that would be crazy. I think right now at the price it's at, it is a crazy good opportunity to get into the market, the best we've seen in a couple of years, you know what I mean? Just look at the graph. It's gone up and up and up and up and up forever. There was one dip, now we're seeing a second dip. I think in another 10 years we're going to see this same trend of up and up and up and up, and it'll be up here somewhere at like $500, and we're all going to be buzzing that we got into it. So despite the fact they don't pay a dividend, I just think this is going to be one of the fastest growing stocks that is out there. I don't see why they would slow down with the amount of money they have, and I am very excited to open a position on them. They're one of the very few massive companies that I've been looking at that I haven't actually opened a position in just yet. So very excited to do so, and I will be doing next week, and I will continue to buy more if they get cheaper and cheaper, baby. I think it's quite nice to have a look at some of these graphs as well. So the earnings per share up and up and up, which is beautiful. Oftentimes you don't see this even with the best companies, okay? Free cash flow per share up and up, and it's been fairly steady then. Sales growth, now obviously their sales growth has slowed down a little bit, but it's still a 27% growth on one of the biggest companies in the world. That's a lot. Obviously it's easier to grow back here when you're a smaller company. Again, Facebook is one of these companies that doesn't need too much explanation. It doesn't take a genius to figure out that they're probably a good investment, and that's why I'm very excited to be getting into them. So guys, that is it for today. That's 5 more stocks I am really excited to be investing in very soon if I'm not already invested in them, and hopefully you guys were able to take something from today's video. If you did, again, please just smash the like button for me. I appreciate it massively. Drop me a sub so that you never miss a future video, baby. And until the next one, guys, peace.